first place? It's important to ask yourself that question before we kind of jump in. Why should you pay someone to conduct third-party due diligence? Uh, is it that it's required by investors? Does a bank want you to get this? Are you looking really just for peace of mind? If you're a self-funded searcher or even an independent sponsor, are you looking to just get that second set of eyes? So peace of mind could be one of the driving factors on why you get due diligence. Um, if you're going the route of, being mandated by a bank or investor, that's often very common for why you conduct due diligence. But more importantly, if you are going through the SBA, they don't require a QofE, but as someone who is personally guaranteeing a loan, it's very important that someone does get a second set of eyes. So I do like to ask the question of like why hire anyone in the first place before we begin. So if we want to just keep tricking down to the next slide. What are you looking to accomplish with hiring someone? So picture you hire someone for due diligence and you know you kick off the QofE. Is the goal to produce a third-party report so you can solicit investors or satisfy the criteria mandated by the bank? I think asking yourself the question of why should I hire someone? And after I hire someone, what is the end goal? Is the end goal to get comfort around the financials? Um, is it a mixed bag of both? So I think asking yourself these questions is important before you do commence any formal process. As a financial due diligence service provider, um, we can assemble and add on to your deal team quite quickly. So it's very important you ask yourself these questions before you begin, because uh, while we do the best to not overwhelm you through the process, we can typically be added on to your deal in the role of a QofE team within 24 to 48 hours. So the question is when should you engage a QofE provider? So if you want to flip to two slides down, that'd be helpful. So when should you reach out to a quality of earnings provider in your process? So if you're starting your search, actively searching, you're likely somewhere on the left side of this, image. Um, you could be starting and actively searching for several months, maybe even up to a year or 18 months. When you do identify a business that you like and you're seriously considering submitting an LOI, um, as pictured in the graph, once you do submit that LOI, it's best practice to book a call then. Uh, Often I'm asked, I'm contacted by people and folks starting their search or those who are actively searching, but they don't have a business in mind. It's the challenge with speaking to providers at this stage is I can only give you so much advice as to it pertains to like a specific deal. So if you are just starting your search, it's such an exciting time. But from a quality of earnings standpoint, when I analyze a specific deal without knowing the type of business or the industry, it's very challenging for me to give you valuable advice on how to diligence a specific deal. So without that last factor, it's often not as valuable early in your process to speak with a QofE provider, maybe even a lawyer. When you do identify businesses that you will submit letters of intent or LOI for, then it's certainly very appropriate to book a call and contact myself or someone on my team. Uh, from there, assuming your LOI is signed by the sellers and it's formalized, you can quickly commence due diligence. Um, so that is really, on the right after you book the call and assuming you move forward with selecting a QofE provider, close within the same week or so, your signed LOI will start and also your QofE project will start. So if you want to scan, the QR code on the right, you could book a call directly with me. If you do have an LOI or you found a business you're excited about and you think you need help with due diligence. Um, so let's break down the days of, a typical LOI period. So if you want to go back one slide, perfect. So picture this. You are you just signed your LOI. So if we think back to that um, last image, you just signed your LOI and you have 90 days of exclusivity. So the 90-day exclusivity period is laid out right here. What different levers and uh, deal team, objectives do you have to accomplish? So typically in the first 1 to 30 days is when you start financial due diligence. So the question I'm asked is, when should I start certain things, etc.? The reason why you should start financial due diligence in the beginning of your LOI period is you need to verify the revenues, expenses, and net incomes that were presented in the SIM or marketing materials, and verify that they are tying out and confirmed based on the granular data in the accounting system. So I'll give you an example. If you submitted a letter of intent based on the broker's SIM or marketing materials, which shows net incomes of $5 million, the first step of financial due diligence is running the income statements and balance sheets to prove out that the business net income's tied to that $5 million amount. Some of the things that often happen are there are variances or discrepancies in the number shown in the SIM compared to the number shown in the QuickBooks or granular financial data. Whether or not those variances impact the deal itself depends on a number of factors. Is there certain reasons why there are variances? Is it a tax to book issue, etc.? The point being, the reason why financial diligence starts in the beginning of the LOI phase is because without running this light verification of just the revenues, expenses, and incomes, it doesn't make sense to start the rest of the process. So you'll see if we pan down, the next is the SBA bank underwriting process, which typically can commence either simultaneously with financial due diligence or a few days into due diligence. And that's just due to the time it takes for the underwriting to occur. About halfway through financial diligence, it's best practice to start tax and legal due diligence. The reason why it's a shotgun start in financial and then almost phase two is tax and phase three is legal is because once the financial due diligence piece is complete, and let's say in a perfect world the financials check out at a high level, then it's appropriate to start things like the tax, which is reviewing tax compliance, understanding there's not any hidden liabilities, etc. And then if that continues to check out, moving into legal due diligence, which uh, assesses if there's any outstanding legal issues, and then more importantly, an M&A attorney as a part of their legal due diligence will commence the purchase price, writing up the PPA or the purchase agreement, which is the assumptions and the reps and warranties of what is really the final living document, which transfers ownership from the new buyer from the seller. So that's the typical timeline from, a 90-day LOI. So you can apply this same sort of number of days to a 30-day LOI, 60, 90, 120, 180. The point of it is by understanding when you should engage and start providers, one, it can save you money. Rather than paying all of these folks up front simultaneously, you should ensure that they're done in sequential order because if there is material deal findings, This will protect your downside risk for deals breaking, etc. So feel free to scan, this QR code or save it, bookmark it or screenshot it. Use this on every deal because I do think it's helpful to see from a day's standpoint, what this looks like. So I think if we could pan to the due diligence process, that could be helpful as the next one. So if we go to two down, and if we want to zoom in, so what does a typical like due diligence process look like? Um, if you want to just go back, there we go. So typically the due diligence, and if you hold control and just zoom in, that should work without skipping the slide. Yes, if you hold control and then just go back one. Control and then zoom in on the map from your mouse. Yeah, perfect. And then yeah, there you go. So what are the components of a typical due diligence process? I break it down in this one pager into seven simple steps. Really, the phase one is the preparation and planning. So if we think back to when should you engage, a financial diligence provider, it's typically when you have a business, a specific target business, one company or multiple companies that you can begin preparing and planning for of how we're going to diligence this appropriately in a cost-effective manner and focus on the risk areas of the particular business. So you're going to collect, the data collection phase, um, have your kickoff call, which is a meeting between the buyers and sellers and the seller's CPA to walk through what the engagement's going to look like. Um, from there, you're going to conduct, an assessment of the financial function of the team, examine the contracts and agreements, and then move into the analytical procedures. So the analytical procedures will include things such as the financial statement review, um, which is the income statement and balance sheet review. Based on the type of deal you're looking at, the income statement review could contain things such as revenues, a gross margin analysis. Uh, this one pager is sort of a one size fits all of all the analysis which comprise it. Depending on the type of deal you'll look at, we'll also conduct a balance sheet review, which is going to look at things such as AP, AR, related parties, tests around commitments and contingencies. If there's inventory involved, if it's a manufacturing company, there might be raw materials on hand. So that's going to be the components of the balance sheet review. Um, from there, step seven is formalizing and finalizing the results of diligence. So the big ticket item is the quality of earnings, which is really, this category means what is adjusted EBITDA or SDE look like on a normalized basis. Uh, that is a culmination of all of these steps, so steps one through six. There may be certain items or due diligence adjustments which raise or lower this amount. So, for example, if we go back to the first example, if the business was showing a $1 million profit, um, if the business was showing a $1 million profit, in step seven, the due diligence adjustments will either raise or lower that $1 million amount. The net working capital piece is a separate analysis which identifies what is the net working capital amount um, that should be included in your deal. In other industry terms, this is often referred to as a net working capital target number. Um, I hold a separate webinar and I speak about this on a standalone basis of how to calculate net working capital, what are the components, how to think about working capital in your deals. So if you want to, check out my YouTube channel or follow along for my other webinar series, I do a deep dive in what is working capital and why it matters to your deal. So I encourage you to check out some of those videos on my YouTube channel. The last two pieces of step seven are other standalone analysis, such as the proof of cash. So the proof of cash reconciles the bank statements to the reported revenues and expenses from your accounting records. So to break this down and explain it in a very simple manner, it essentially you will analyze and plot out monthly inflows and outflows from the bank statements, and you will compare that to reported revenues and expenses from your QuickBooks financial statements or other, financial statements. Uh, After comparing those and understanding what the variances are, what's left is should be non-operating activity from the bank statements uh, that's not being included in your analysis. This is a helpful exercise, which essentially is, the fraud test to make sure that there's not material discrepancies between reported revenues per QuickBooks or financial data compared to the actual dollars uh, coming into the bank and being dispersed from the bank. So it's a good check on revenue and expenses, which should be incorporated into any, financial diligence. The last piece is a debt-like analysis. So typically, transactions are conducted on a cash-free, debt-free basis. Your debt-like analysis looks to identify, some of the debt-like items in the company's financial data and call those out and explain how those relate to your specific deal. Um, so this one pager can be accessed via my buyer's toolkit. So if you head over to my X channel, you can get a copy of this. It's included on one of those pages. So what are my options of which sort of financial diligence makes sense for my deal? So I break this down into two options. The first option is what I like to call a quality of earnings light. So if we head over to the next slide, we can show the breakouts. So think back to your deal and ask yourself, what am I looking to achieve? Why would I hire a quality of earnings provider? Is it bank mandated? Am I looking to sleep soundly at night and protect my investment? Uh, if you are seeking, if you're mandated by the bank to conduct a quality of earnings, or investors, such as limited investors, are mandating a third party conducts it, you likely will need what I call a comprehensive financial diligence. So this is the most popular package because it provides a formatted investor bank approved PDF report along with a data book covering the full gambit of financial diligence. So if we flip back to, staying on this screen, but if we think back to what those seven components of full financial diligence, all of those steps are included in comprehensive. Um, you have things such as the revenue gross margin analysis, reconciliations to the tax returns and payroll, as well as a management interviews, which are several management calls with the sellers to understand, why they're selling the business, learn more about their operational aspects, which, can be very beneficial for prospective buyers. On the left, if you are a, self-funded searcher, maybe you don't need a mandate for a QofE. You're pursuing a SBA loan. Um, Typically, it's an SBA 7A loan to buy this business. But perhaps you want a second set of eyes. You're nervous that you may, you might not know accounting. You may be comfortable with the numbers, but you just would like a second set of eyes to make sure your multi-million dollar investment um, is going towards a good business with verified earnings and can support the SBA loan. If all of these things sound like you, a QofE light data book is typically your best option. So this is a light review. So if we think about those steps and the full gambit of analysis, it's typically about half, which looks to verify the high risk areas of due diligence. So it's still going to conduct a proof of cash, You're still going to do a P&L and balance sheet review, and it's still going to look to uh, verify the incomes, revenues, and costs of the business without the flashy PDF report. So the good news is this is can be very budget friendly from, you know, a self-funded searcher's perspective, but it still gives you that reassurance that you're buying a good business with strong earnings and there's not significant material discrepancies in your deal. Uh, so if you are a, self-funded searcher and you think this QofE Light data book sounds like something you may need for your deal, I'd be happy to meet and speak with you. Um, in closing, if we want to head down to the next slide, if you for those of you joining the live stream, if you want to scan this QR code, this will take you directly to my financial data checklist. So it's a 10 to 20 point data Excel file, which I use on all of my deals. It gives you a clear shot of what kind of data documents you actually need to conduct due diligence, or if you're doing a light verification yourself. So feel free to scan that QR code and receive a copy. Um, Additionally, if you want to reach out to me on, LinkedIn, I think I have this pinned to my profile, and I'd be happy to give it to you. Um, these are some of the upcoming webinars I have. So if you want to bookmark these and register via Zoom, you should get reminder emails about some of these that are upcoming. Essentially, this is part of the 2025 webinar series, which really looks to arm independent sponsors, self-funded searchers, and those looking to buy private businesses with the tools they need to do better deals and protect their investment. Uh, so we're going to cover things like how to conduct a proof of cash, um, how to structure deals and finance them. Uh, And additionally, we're going to do a deep dive into that 90-day deal framework and break down, how do you assemble a deal team, etc. So the aim of all of these series is really to empower the acquisition community. I love working with acquisition entrepreneurs. So if you want to reach out to me on LinkedIn and say hi or talk about your deal, I'd be more than happy to dive in a little deeper. Um, with that, I will flip to some of the last slides. You can find all this content on my YouTube channel. Um, I have shorts, long forms, wonderful guests that have been kind enough to join, and really it is to empower the entrepreneur community to buy these small businesses, improve your operations. So if you're looking to buy a small business, sell one, or just improve it operationally, there are hopefully some valuable nuggets on my YouTube channel, which you can view anytime. Uh, with that, thank you for popping into my live stream. If you want to say hi or give me some tips about ways to improve this, I have just kind of started tinkering with the live stream. So, feedback is a gift. I'd love to hear from you. If there's topics you think, could be valuable to cover, feel free to reach out to me on LinkedIn or X with topic ideas because I'm continuing to try to focus more on valuable content for those of you who listen in. So any feedback about the streams, etc., feel free to give me a shout. Um, with that, I'll go ahead and head out for today and enjoy the rest of your evening. All right, take care, everyone. Bye bye.